Investing in stocks is a great way to make some money and grow your wealth over time, but the stock market is a hugely complex network and it requires someone to facilitate all of those transactions and ensure all the integrity of the data. And that's where the proverbial seller of shovels in a gold rush comes into play, which is the company we're going to talk about in today's video, Intercontinental Exchange, ticker symbol ICE. So we'll be analyzing ICE's stock and trying to decide if it's a good company that we might want to own. This is the 8th episode in my subscriber suggested stock analysis series. So if you are interested in having me analyze a particular stock, let me know in the comments down below or join the free Discord and send me a message there as well. ICE's business is rather complex and, at least for me, a little bit hard to understand in some parts, but they basically serve two main roles. So, firstly, they facilitate transactions between parties in the various financial markets by providing liquidity. And then also, they offer real time and historical pricing data and transaction information for a vast array of financial products and markets. That's the main gist of what they do, but they also break their business down into three different segments. So we're going to take a look at those individually. The first segment is the exchanges segment, and this accounts for about 55% of ICE's revenue. This segment offers a wide range of futures, options, and equity products in the areas of energy, agricultural commodities, common stocks, and OTC energy markets. And notably, this segment does contain the New York Stock Exchange, which ICE fully owns. The next segment is the fixed income and data services segment, which accounts for about 30% of revenues. And this segment provides execution and clearing for fixed income products and markets, as well as real time pricing services and data for over 3 million fixed income products. The final segment is the mortgage technology segment, which is the newer segment that currently accounts for just 15% of revenues. And basically, this segment is aimed at identifying and solving inefficiencies that exist in the US residential mortgage market. So this includes automation of processes and quicker connections of different parties involved in the lending process. And again, this segment also provides lots of data and analytics surrounding the real estate markets that their customers can use. And ICE is definitely continuing to invest in this segment. Like I said, it is a little bit of a newer segment that they're trying to grow. So they just acquired a company called Black Knight, which is a software and data company that serves the real estate and housing finance markets. So that acquisition was actually valued at about $12 billion and was completed in early September of 2023. One of the great parts about ICE is that about 50% of their revenue is reoccurring, and then the remaining 50% is transaction based, volume based essentially, meaning that inflation doesn't really directly affect their business, though the overall state of the economy, which can be affected by inflation, can affect their business for sure. So let's take a look now at how ICE has been performing recently. They just reported their second quarter earnings for the quarter that ended June 30th, and they reported those at the beginning of August. And for that quarter, they had revenues of $1.9 billion, which is up 4% year over year. And that is net revenues. Their actual revenues were a little bit higher and were down just a tiny bit. But this reported net revenues is after fees that they have to pay to certain entities. And then operating income for the quarter was $955 million, which was up 10% year over year. And then earnings per share was $1.42, up 43% year over year. So looking at revenue by segments, we can see that the exchanges segment is the most profitable at a little bit above 70% operating margins. And then the mortgage segment is actually still unprofitable. And hopefully they can keep working on that as they acquire new businesses within the mortgage segment. They're probably going to have some growing pains, of course, but hopefully over time they can improve that. And looking at the mortgage segment as compared to Q2 of 2022, revenue for that segment was actually down 16%, and transaction revenue was down 38% for the quarter, which isn't a huge surprise given the rising interest rates over the past year. And looking at the income statement, the full income statement in comparison to Q2 of 2022, 2023's numbers are, for the most part, just slightly better throughout most of the income statement. The one noticeable difference is that they had much lower income taxes this year in 2023 so far, and that has kind of helped them with that larger 43% increase in earnings per share for the second quarter versus just a small increase in revenues for the quarter. Now, financial strength is very important when it comes to a company like ICE because very large portions of the financial markets are depending on them to have the liquidity and the capital to keep everything running smoothly. So let's take a look now at their balance sheet to see how prepared they are. At first glance, the balance sheet does look very odd, especially when compared to the end of 2022. So the main component of their assets that we see here is this item included in current assets, which is called cash and cash equivalent margin deposits and guarantee funds. And this item is a little bit hard to understand, at least for a layman like myself, but my basic understanding is that members of ICE's clearing houses have to deposit these funds to ICE as collateral or liquidity in order to make transactions. And so this current asset here is fully offset by a corresponding current liability that we can see below. And basically, ICE will owe that back to members that deposited that amount, should those members choose to no longer do business with ICE. So that item really, from my understanding, isn't really all that important since the asset is completely offset by the liability. But what I would like to understand is why that number decreased over 50% in just the last 6 months, from the end of 2022 to the middle of 2023. I'm kind of thinking it's just an indication of generally lower margin requirements and lower volatility or risk assessments for certain trade types currently because generally speaking, volatility is down significantly this year. But that may not be completely right. That's just kind of a guess on my part. The good thing, though, is that ICE's current assets of $99.2 billion exceed their current liabilities of $90.2 billion, which is always a positive sign. Another positive sign is that they have absolutely no short-term debt right now, but on the other hand, they do have a full $18 billion of long-term debt, which is much higher than what they had this time last year. And I believe that's because of the Black Knight acquisition and having to take on debt for that acquisition. But as we can see from the details on their 2022 10K from the end of 2022, they only have about $2.5 billion of debt that is due before the end of 2025. And they have a lot of debt throughout the 2030s and 40s, and even some into the 2050s and 2060s, which I think is generally a good thing because it means they can really focus on improving their operations now, especially building out the mortgage segment into a stronger and more profitable business. And they'll be able to do that without having to worry too much about paying down their debt. But I still do think debt is on the higher level and is not super ideal. But also for this type of company, like a financials company that does this kind of business, I think, higher debt may be typical or at least more reasonable. But again, like I said, I'm not super knowledgeable about these types of businesses. And looking at the debt to equity ratio as well, that is below one, which means, their debt is a little bit on the higher side, but it's also not, super out of control, I think. And that means that they still have more equity on their balance sheet than debt. Moving on now to those juicy dividends, ICE currently has a relatively modest dividend yield of about 1.5% and a more impressively low payout ratio just below 30%, which means they do have lots of room to grow the dividend in the future should they want to. And they have been growing their dividend for about 9 years consecutively now since they started paying dividends in December of 2013. And over the past 5 years, they've grown the dividend on average 12.26% per year, which is a pretty great rate of growth. The question really becomes then whether they can sustain that rate of growth over a longer period of time. And I think they probably won't be able to sustain quite that, 12 plus percent, but maybe something in the 9 to 10 or 11 range, I think would be more reasonable. Right now, in terms of earnings growth, their trailing 12 months earnings per share has grown at almost 10% annually for the past like 10-ish years. So I think, if they can continue kind of that earnings growth, then they can continue growing the dividend around 10-ish% per year. We now have an understanding of ICE's business model, their recent performance, and their financial strength. So let's try to understand now how the market is valuing them and how that compares to what their fair or intrinsic value might be. So first, we'll take a look at the PE ratio, and we can see right now that the price to earnings ratio is a bit higher at around 35, which is well above their historical average of about 23. And another way to use the PE is to compare it to the PE of a company's peers. So ICE is in the financial services sector, which right now has an average PE of about 11. And then within that sector, they're in the capital markets industry, which has an average PE of about 21 right now. So ICE appears to be a little bit overvalued when we look at the price to earnings ratio. But I think it's notable to understand as well that their earnings per share in 2022, at the end of 2022, was a little bit lower than normal. And that was because they have an investment in a company called Bacht, which took some losses actually in 2022. And so those losses carried on to ICE's income statement because of their high ownership stake in the company. And that kind of greatly reduced their earnings per share for the fourth quarter, which reduced their trailing 12 months EPS. So that PE ratio is a little bit high, and most likely, as long as nothing similar happens this year, then that PE ratio will correct and will be a lot closer to the historical average by the end of the year. I usually do a discounted cash flow calculation as a second method of valuation, but because of the nature of ICE's business, it doesn't make as much sense to use a DCF model. But I ended up doing the calculation anyway, just for kicks and giggles, and ended up getting a fair value of $45 per share, which is way below the current price of around $105 per share. But like I said, that isn't a very good assessment of ICE's true fair value just because of the nature of ICE's business. A better metric would be something like a price to book ratio or price to book. And right now, ICE's price to book ratio is 2.5, which is pretty much in line with the capital markets industry, which also has an average price to book ratio of 2.6 right now. So I think from kind of looking at all those factors, I think ICE is, around a fair value, or at least a reasonable value right now. I think like I said, their price to earnings ratio will probably correct by the end of the year to be more in line with the historical average, as long as there's no similar losses from Bacht, and as long as the stock price doesn't go way up or anything like that. Overall, I do think InterContinental Exchange is a very high quality business that is a key player in the financial markets right now. And like I said, I am no expert in these industries. I do think there could be some risk involved in the business in terms of, how replaceable they might be if there's some kind of big change in how financial markets operate. And I'm really not sure what that change would look like, but I think given how quickly some things are changing these days, there's probably potential for that to happen. And, if they kind of miss the boat on that, they could be pushed to the side and not really needed anymore. But if there's risk for that happening, I'm sure, people in that business, in the company, are kind of looking at that and keeping up to date on new technologies. And, even if they don't, create that technology within their business, maybe they have the capital to acquire another business that's doing that, and that way they can stay relevant. Like I said, I don't really know how much of a risk that is, but it's something I was thinking about a little bit as well. But one of the things I really do like about the company is that it's still led by its founder, which is Jeffrey Sprecher, who founded the company in 2000, and he's still the CEO to this day, which I think, first of all, is just a cool thing. But secondly, I think it's great for the company because he's accumulated a lot of knowledge about the business over the years. And so he probably has a lot to contribute to the company, but also to share with other people within the business to help them do their jobs better as well. Another thing I like to look at is share repurchases, and ICE does do some share repurchases, but they've largely negated the effects of those share repurchases by issuing shares in stock-based compensation and acquisitions. It's definitely not the worst problem to have. It's certainly better than doing those things and then not doing any share repurchases so that your share count goes up. But it is, I think, less than ideal. It would be better if those share repurchases help to bring the share count down on a net basis. And I definitely would say, in general, I don't know enough about this company right now to go commit to buying some of the stock. But from what I do know right now, I think, like I said, it's at a relatively decent value. The stock was below $100 per share just in March. So there's certainly been opportunities, I think, to get an even better deal quite recently. And if anyone does have any specific knowledge about ICE or that specific industry, I would love to hear about it, since I'm not as knowledgeable, and myself and surely others could use your opinion down in the comments below. Be sure to join the Discord as well if you're interested in chatting about the stock market or specific stocks with myself and other investors. And I just want to thank everyone for watching to the end of the video. I really do appreciate that, and I'll see you all in the next one.